Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Hi everyone, welcome back to another Bondcast episode. It's a busy week this week, particularly here in Europe. We've had a big week of supply, we've had an ECB meeting and an Italian political crisis to contend with. We'll deep dive on our latest thoughts on that in a minute, but first let's get a quick stock take from all of you on your thoughts this week. Blake, I'll start with you. It was a pretty big week, I guess, on the global stage for the US this week with a new president, and without getting too political, I say very happily a new Madam Vice President as well. So what's your latest thoughts this week, Blake?
Yeah, absolutely. It was obviously a big week on that front. I think, that was more politically, personally for a lot of people, but from a market perspective, it wasn't particularly impactful. We already have a pretty good idea of what Biden's early term fiscal economic priorities are going to be. Those have already been sketched out. So, a lot of the flurry of executive orders we saw on his first day in office, nothing that would really kind of push markets around. And to that point, I think after the big post Georgia election sell-off that we saw, rates over the last week have kind of settled into a new equilibrium. We've had 10s kind of trading in this 107, 112 range for a week. So things have really kind of calmed down in the US side. I think looking forward, the big focuses are obviously going to be, how the negotiations on this fiscal package start to take shape. Obviously, a big piece of that will be whether they try to do it in a bipartisan fashion through the regular process, or whether they go to this kind of special reconciliation process, which would presumably allow Democrats to pass something without any help from Republicans. That creates a pretty wide range of outcomes of where that could go, but this is something that's going to take shape over the next few weeks, and we'll probably have a lot more to say about it later on. We've also got FOMC meeting coming up and a refunding announcement from Treasury coming in the next few weeks. Both of those I would expect to be fairly uneventful. Lastly, I would just say we did have Yellen on the refunding front. We did have soon-to-be Secretary Yellen talking to Congress as part of her confirmation hearings. There was a little bit of focus from markets on some comments she made around 50s. I'm completely dismissing those. She was asked directly about 50-year issuance, and she was just kind of responding politically to that. So, I don't think there's really anything there kind of signaling that they're going to go back to this ultra-long bond discussion. So quite a few stories kind of developing over the next few weeks, but for now, it looks like we've settled into this period of calm for now.
Okay, thanks, Blake. So Giles, over to you. I did say that we'll use the second half of this podcast as a kind of deep dive into what's been going on in Europe this week, but if you could just give your high-level elevator pitch of your latest thoughts, given everything that's gone on this week.
Right. Well, I suppose, yes, I guess we would start with the ECB, but we'll get on to that. Overall, I think, the real problem is that we don't know what to think about European rates. Most of the time I've been, talking and thinking about why it is that European rates just don't really seem to respond to anything. So we can get into that. But, I think that the real confusion is, I guess about why there are signs of reflation sentiment picking up elsewhere, but European rates just trying to buck that trend or just ignore it. And the other thing, I suppose, was in Italy, where we had a nice round trip in BTPs on a little bit of a political scare. And I suppose that we would expect the improvement that we've seen since that was resolved or semi-resolved to continue.
Okay, great, thank you. And somewhere where we did have a little bit of a pickup in inflation in the UK, Theo, what are your latest thoughts on gilts nowadays?
Yeah, it's definitely an interesting market. What we've seen is, a market where duration has been very easily absorbed. So we had the syndication this week, and we have another linker syndication in early February. So this is positive for gilts. What is, however, interesting is, and what makes me a bit concerned is market expectations with regards to lower rates and the shape of the curve. So they extend to which the gilt curve is fairly steep and at a low level. I think two key points, and we'll discuss also more on that, is the BOE meeting in early February, which will provide color in either validate or really refute all those expectations on lower rates, and also the March budget. So in our view, there is a lot more need for fiscal policy to deliver and to help the UK economy rather than monetary policy.
Okay, perfect. Thank you, Theo. So let's start with on our deep dive then, and we'll start with Europe because, like I said in the intro, I think it's been a pretty busy week here in Europe. And so, Giles, we've had this political crisis, well, been going on for a couple of weeks now, but really kind of came to a head, I guess, this week in Italy. And BTP spreads, like you say, have done pretty much a round trip now. Do we think this is kind of the end of the political crisis? What are we watching out for from here? And do we think BTP spreads are going tighter from here, or are they now as tight as we think that they can get?
Yeah, so I think on Italy, our thinking really hasn't changed all that much. Clearly there are some lingering risks, but I think that they are risks that we're fairly comfortable with from two regards. I mean, first of all, yes, it's true that we haven't completely got away from the possibility of a new set of elections, possibly sometime late in Q2. But the window for that to crystallize is probably only a few weeks long. The timeline from there on would probably takes us all the way actually into 2023 for new elections, and so we'll probably end up with just various configurations of the current parliament. But then in the background you have a makeup which although yes, in the case of new elections you could see things swing towards the centre right, and I think that people are still sort of stuck in the 2018 mentality to a certain extent and think about that as potentially a swing towards Euroscepticism. But we don't see it like that. And I think the more that people think about it, they will come to the same conclusion. And really, when it comes down to it, in this environment where yes, of course, there are questions about debt sustainability that, over the very long term, I think that those have largely been put to one side, and put to bed, if you like, by, at least for the short term, right, by what the ECB has been doing, and also the Recovery Fund initiative, which both encourages our confidence in the strength of recovery, which is, of course, what's needed to put debt sustainability in Italy back on the right track, but also has helped to squeeze spreads and actually yield levels in general to a level where there really isn't the need to have the same kinds of concerns that perhaps we might have had in 2012, 2013, because yield levels, and this is something that's always worth repeating whenever we talk about Italy, yield levels, when they fall below the level of trend growth in real terms, the natural tendency over the long term is for debt levels to fall. And we're very much in that in that dynamic at the moment, and I think it would take a very, very significant shock to get us out of there. And I think markets understand that, and so overall, I think that people still look at Italy as reasonably attractive way to pick up yield. And something I've listened to you repeat plenty this week, Imogen, is that there are potentially ratings upgrades risks for Italy that people perhaps don't have on their radar but should. And also, although one thing that we've been repeating is that investors should maybe increasingly look towards the US for ways to pick up yield, they can still get yield in a quite attractive way in Italy. So if they want to stay in euros, so I think that those are two other considerations that that really matter too.
Okay, so still a kind of gradual grind tighter than we think in Italian spreads to German bonds. So On the topic of yield and moving swiftly over to the ECB, because that was the other kind of event that we've had this week. It was a relatively uneventful meeting, I would say, not that anyone was expecting it to bring much, and we had big policy action in December, so now wasn't really the time to recalibrate policy again. But one of the clear focuses over the last few days and in the Q&A and the meeting today was around this idea of yield curve control and whether the ECB do or do not do that. Can you just update us on your latest thoughts around what we're thinking around yield curve control and whether it's something that the ECB do or indeed might do in the future?
Well, I think our basic thinking about this is that it's kind of got onto the market agenda in quite an annoying way. I mean, it's tempting to more or less dismiss it as a bit of a just as, I guess, an invented story. We've been talking about it as a red herring, something which in a quiet market people kind of want to latch onto. I mean, it's all good and well to try and find names for what's going on, and particularly parallels with what's happening in other markets. And I suppose that Japanification of Europe is something that people have been keen on for a long time. But although I think we counted, didn't we, 4 questions on the subject today, and I think it was really put to bed the first time, and it wasn't even probably necessary the first time. The second one's looking, and third and fourth, all looking for clarification. Turned what was a pretty dry press conference into an utter waste of time, in my opinion. I think the conclusion is, yes, of course they're doing something that's like yield curve control. Do we need that label for it? No, obviously not. I think it's pretty clear that what they're doing is they, in this kind of, as Ms. Lagarde described it, the sort of holistic approach that they're taking to financial conditions. Effectively, what they're doing is they have a scorecard that they're working towards, and they want, and across the broadest range of indicators possible, they want to optimize financial conditions, really to accompany the recovery. And they'll more or less do what they need to keep us on a sort of stable path there. So what does that mean for the PEP, which is obviously the other thing that people are trying to sort of draw out of this discussion? And there are a few questions on that too, which also I think were unnecessary. Now, what does it mean for that? Well, I think it's pretty obvious that what it means is that they don't want to squeeze the market unnecessarily by just filling quotas on a monthly or weekly basis. So if the market is on the right side for them, then they'll just do what they need to do to keep things going. And if not, then they'll step things up. If markets have a little bit of a wobble, maybe there's some kind of event, or they, from time to time we've all seen it before. People aren't really sure about the ECB or another central bank's commitment, and they put it to the test. And so in that case, they can step up purchases. Fine, so it's flexible in both ways. I don't think that's too hard to understand.
Yeah, I think that makes sense. And I guess the implication, well, as you say, for markets is that they don't want to squeeze them unnecessarily, and therefore should be a good thing for our bearish Bund call. So with that, Theo, I'll switch gears and move over to the UK, because I know you've got some interesting things to speak, particularly about the shape of the curve. I know that, one of our big calls in the year ahead was for steepness, both in the US and in Europe. But conversely, in the UK, there's already a very steep curve there, and oddly at quite low levels of rates. So you're actually looking for the opposite, aren't you?
Correct. And this is very well phrased, Imogen. So when you compare the UK curve to other curves, the interesting part is the steepness that you have at a low level, simply because the market prices in the possibility that at some point the front end of the curve will gap a lot lower. So the excitement across the investor base is really that while you may buy gilts at minus 10 basis points, well, those gilts may end up at the level where you have Schatz, for example, in Germany. So the investors look at that potential upside and they treat long positions as an option. Indeed, one of our calls is really that we push back on that, and I think that this is quite important. So negative rates are not something that you can get simply because was just the inflation number a bit weaker or growth was a bit softer or something like that. It's obviously very committal. It's a very significant decision to the extent that you signal that you want to move the effective lower bound of the bank rate a lot lower. It does have implications. So in that regard, we will get more light and more clarity on the 4th of February with the Bank of England monetary policy report. But what is interesting is that there seems to be a divide among BOE policymakers. For example, Silvana Tendrero, she gave a speech, let's talk about negative rates. And as you can imagine, it was about negative rates and what the merits are of that measure. And we can imagine also Gert Liege being, to some extent, supportive of lower rates. But it is very interesting that other members of the Bank of England have not validated this step. And more importantly, Governor Bailey this week, when he was asked about lower rates and when he was asked about the need for additional stimulus, he mentioned that the UK economy has been adapting to COVID and is able to operate also with lockdowns and restrictions. So if I put all those points together, then we've got a solid case which actually is against lower rates. Now, what does it mean? Well, it means that you may have some flattening of the curve, but that flattening to be driven from the front end. This is actually something interesting because as things stand, the front end is relatively less volatile compared to the longer end of the curve. So we think that, if when we look at that shape, we think that relative to the current dynamics, the front end of the curve can underperform. Now, other things that are very important looking forward is really the syndications and issuance. We are in a regime of positive net issuance in the market, and this is significant. So basically what is being issued by the government is a lot more than what is being bought by the Bank of England. And that does exert some steepening bias at the back end of the curve. So this is also an important theme. We had this indication this week. We have a linkage indication most likely on the 9th of February, again, subject to market conditions. But I think net DV1 will be quite a key aspect. Now, in terms of signals and in terms of indicators that we closely track, one is inflation, and inflation numbers this week, they were fairly decent. They could have surprised to the downside, but they didn't. Housing inflation was rock solid. We had a rebound across clothing and we had a rebound in travel. So there were several items that were on the stronger side. And also when we look at, for example, things such as, growth was not that weak. So in terms of data, it looks pretty solid for the UK, and there doesn't seem to be a need to signal or deliver lower rates anytime soon. And that, as said, has got implications for the whole curve. So that's all from me this week. I wanted to keep it brief and provide yet quite some color.
That was great. Thank you, Theo, and thank you, Giles and Blake, as well, for your thoughts this week. And thank you all for joining another Bondcast. We'll be back next week, and what will be another very interesting and exciting week in rates markets. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.